Let me paint you a picture that is happening to hundreds of thousands of retirees right now across America. You retire. You have done everything right. You have a $900,000 IRA. You have Social Security coming in. You have a modest pension. You feel comfortable. You feel secure. And then you turn 73, and the IRS sends you a message you were not expecting. It says, you no longer get to decide how much to take out of your retirement account. We decide now. And by the way, every dollar we force you to take out is taxed as ordinary income. Welcome to your required minimum distributions. Suddenly, your taxable income jumps by $40,000, $50,000, sometimes more, whether you need the money or not. Your Social Security benefit, which you thought was mostly tax-free, is now 85% taxable. Your Medicare premiums spike because of a surcharge triggered by your higher income. And the tax bracket you carefully managed throughout your retirement just blew up. This is the retirement tax bomb. And unlike a market crash, which you can see coming and at least emotionally prepare for, the tax bomb is quiet, invisible, and builds for years before it explodes. Most retirees have no idea it is coming until it has already gone off. Today we are going to talk about exactly what the retirement tax bomb is, why it catches so many people completely off guard, and most importantly, the specific strategies you can use right now to defuse it before it does permanent damage to your retirement. Hey everyone, welcome back to Life Advice. If you have money in a traditional IRA or 401k, and most retirees do, this video is one of the most important ones I have ever made on this channel. So stay with me all the way through, because the strategies we cover in the second half of this video could save you tens of thousands of dollars. Let's get into it. To understand the retirement tax bomb, you have to understand how most Americans save for retirement over the past 30 or 40 years. And the answer is almost entirely in tax-deferred accounts. Traditional 401ks, traditional IRAs, SEP IRAs, simple IRAs. These accounts all work the same way. You contribute pre-tax dollars. Your money grows tax-deferred, meaning you pay no tax on the growth year after year. And then when you withdraw in retirement, every single dollar is taxed as ordinary income. This felt like an amazing deal during your working years. You got a tax deduction on every dollar you contributed. You watched your account grow without a tax drag. And you assumed that in retirement, when you were no longer earning a big salary, your income and your tax rate would be lower. So deferring taxes seemed like a winning strategy. And for many people in many situations, it was a good strategy. But here is what most people did not fully account for. Those accounts have been growing, tax deferred, for decades. And now they are large, very large. And the IRS has been patient, because the IRS knew that at age 73, the party was over. Required minimum distributions would begin, and every dollar that had been quietly compounding inside that tax-deferred shelter would start flowing out, fully taxable, whether you wanted it to or not. Here is how the math works. The IRS calculates your RMD each year by dividing your account balance by a life expectancy factor from their uniform lifetime table. For a 73-year-old, that factor is approximately 26.5. So if you have $900,000 in your traditional IRA at age 73, your RMD is roughly $34,000 in year one. At 75, as the factor decreases, your RMD on a still growing account might be $38,000. At 78, $45,000. At 82, $55,000 or more. And remember, these are not optional. You cannot say no. You cannot reinvest them. You cannot defer them. You must take them. And you must pay income tax on every dollar. Now add your Social Security income, add any pension income, add any part-time work or rental income. Suddenly, your total taxable income in retirement is not the low, comfortable number you imagined when you were 45 and dreaming about leaving the workforce. It is $80,000. It is $90,000. It is $100,000 or more. And it is growing every year as your RMDs grow. This is the tax bomb. And the fuse was lit the day you made your first contribution to a traditional retirement account. It has been burning ever since. The retirement tax bomb is not one single event. It is actually three separate but interconnected tax hits that compound on each other, and most retirees do not see any of them coming clearly until all three arrive at once. Most people believe their Social Security benefit is tax-free. It is not. Depending on your total income, what the IRS calls your combined income, up to 85% of your Social Security benefit can be subject to federal income tax. Here is how it works. The IRS calculates your combined income as your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefit. If that combined income exceeds $34,000 for a single filer, or $44,000 for a married couple filing jointly, up to 85% of your Social Security is taxable. Here is the cruel irony. Your RMDs push your combined income up, which triggers more Social Security taxation, which pushes your income up further, which pushes you into a higher tax bracket. It is a tax spiral, each component making the others worse. A retiree who carefully planned to be in the 12% bracket can find themselves pushed into the 22% or even 24% bracket purely by the interaction of RMDs and Social Security taxation. IRMA stands for Income-Related Monthly Adjustment Amount. It is a Medicare premium surcharge that most people have never heard of, until they receive a letter from Medicare informing them that their premiums are going up significantly next year because of their income 2 years ago. Here's how it works. Medicare uses your income from 2 years prior to determine your current year premiums. If your income in 2024 exceeded certain thresholds, $103,000 for a single filer or $206,000 for a married couple, your Medicare Part B and Part D premiums increase substantially. At the highest income tiers, a married couple can pay $6,000 or more per year in additional Medicare premiums compared to the base rate. And here's the trap that catches so many retirees. A one-time event, selling a home, converting to a Roth, taking a large distribution, can spike your income in a single year, triggering IRMA surcharges for the following year. And because Medicare looks back 2 years, the surcharge can arrive long after you have forgotten what caused it. As we touched on, your RMDs do not stay flat. They grow as you age because the IRS life expectancy factor decreases each year, while your account balance, if invested well, continues to grow or at least holds steady. This means your taxable income from RMDs alone tends to increase year after year throughout retirement, and with it, your tax bill. A retiree who starts retirement in the 12% bracket can find themselves in the 22% or 24% bracket by their mid-80s, not because of anything they chose to do, but simply because of the mechanical math of growing RMDs. This is particularly devastating because it happens during the no-go years, the later phase of retirement when healthcare costs are rising, energy is declining, and flexibility is most limited. The tax burden increases precisely when the ability to adapt to it decreases. So why do so many intelligent, financially responsible retirees get blindsided by the tax bomb? There are 3 specific reasons, and understanding them helps you avoid the same trap. For decades, every financial advisor, every 401k enrollment pamphlet, and every retirement planning article told you the same thing. Contribute to your traditional IRA or 401k. Get the tax deduction now. Let it grow tax deferred. Pay taxes later when your income is lower. The problem is the second half of that sentence. When your income is lower, was never guaranteed. It was an assumption that turned out to be wrong for millions of retirees whose accounts grew far larger than they imagined, whose Social Security benefits were higher than expected, and whose RMDs alone generate more taxable income than their final working salary. The tax deferral strategy is not inherently bad, but it was sold as a universal solution when it is actually a situational one. And for retirees who accumulated large traditional IRA balances, the tax deferral they enjoyed during their working years created a massive deferred tax liability that is now coming due, all at once, on a fixed income, with no salary to absorb the hit. Most financial planning focuses heavily on the accumulation phase, how to save, invest, and grow your wealth during your working years. The distribution phase, how to withdraw, manage taxes, and generate income in retirement, receives far less attention. And the tax planning during the distribution phase is both more complex and more consequential than most people realize. A financial advisor who helped you build your 401k for 20 years may have never had a serious conversation with you about what happens at 73 when RMDs begin. An accountant who filed your taxes annually may not have proactively modeled your future tax trajectory. The people best positioned to help you plan for the tax bomb were rarely incentivized to do it. The retirement tax bomb is not just about one thing. It is about the interaction between RMDs, Social Security taxation, IRMA surcharges, state income taxes, and your investment account structure, all happening simultaneously and all affecting each other. Understanding any one piece in isolation gives you an incomplete and often misleading picture. Most retirees who try to think through their tax situation focus on one element, usually RMDs, without modeling how it affects Social Security taxation or Medicare premiums. And the result is a tax surprise that could have been significantly reduced or even eliminated with proper advanced planning. Now let's get to the part that actually matters. Because the tax bomb can be diffused, partially or completely, if you take action at the right time. Here are the 5 most powerful strategies. This is the single highest leverage tax strategy available to most retirees, and it only works during a specific window. The gap years are the period between when you retire and when RMDs begin at age 73. During this window, which might be 5, 8, or 10 years depending on when you retire, Your taxable income is often at its lowest point in decades. You are no longer receiving a salary. You may be deferring Social Security. Your RMDs have not yet started. Your tax bracket is low. This is the window to convert money from your traditional IRA to a Roth IRA. A Roth conversion means you pay income tax on the converted amount today, at your current low rate, in exchange for tax-free growth and tax-free withdrawals for the rest of your life. And because Roth IRAs are not subject to RMDs, converting reduces your future RMD burden permanently. The strategy is to convert just enough each year to fill up your current tax bracket without pushing into the next one. For a married couple in the 12% bracket, that might mean converting $30,000 to $50,000 per year for several years. Over a 5-year gap period, you might move $150,000 to $250,000 from taxable traditional accounts to tax-free Roth accounts, dramatically reducing your future RMD exposure. Research from financial planning firms consistently shows that retirees who execute a systematic, multi-year Roth conversion strategy during the gap years save significantly more in lifetime taxes than those who convert all at once or not at all. The key is the bracket discipline, converting enough to optimize your current bracket without crossing into a higher one. If you are 70 and a half or older and charitably inclined, this is one of the most tax-efficient strategies in the entire tax code. A qualified charitable distribution, or QCD, allows you to transfer money directly from your IRA to a qualified charity, up to $105,000 per person per year, and have that distribution count toward your RMD without being included in your taxable income. Think about what that means. Instead of taking an RMD that flows into your income, gets taxed, and then you write a charitable check from the after-tax proceeds, a QCD goes directly from your IRA to the charity. You satisfy your RMD obligation. The money never appears as income on your tax return. You get no tax deduction, but you also pay no tax. For retirees who would otherwise itemize charitable deductions, this often produces a better tax outcome because the standard deduction is now so high that many retirees cannot itemize effectively anyway. A retiree with $400,000 in a traditional IRA facing a $15,000 annual RMD who donates $15,000 per year to charity anyway could eliminate the entire RMD from their taxable income using QCDs. That single strategy could reduce their taxable income by $15,000 per year, potentially keeping them in a lower tax bracket, reducing Social Security taxation, and avoiding IRMA surcharges entirely. We have covered Social Security timing in detail in a previous video on this channel, but from a pure tax perspective, delaying Social Security and drawing down your traditional IRA in the early retirement years has a powerful tax optimization effect. Here is why. If you delay Social Security from 65 to 70, your benefit grows by approximately 8% per year. But during those 5 years, you need income to live. If you draw from your traditional IRA during those years, at potentially low tax rates during your gap years, you are simultaneously reducing your future RMD burden, optimizing your Roth conversion window, and setting up a larger Social Security benefit that arrives in a more tax-efficient form. It sounds counterintuitive to draw down your IRA early and wait on Social Security. But from a total lifetime tax perspective, it is often the most efficient sequence, particularly for retirees with large traditional IRA balances who want to reduce their peak RMD exposure at 73 and beyond. IRMA surcharges apply in income tiers, not as a smooth increase, which means a single dollar of income above a threshold can trigger thousands of dollars in additional Medicare premiums. This creates specific income levels that function as cliff edges. Crossing them is enormously expensive. Staying just below them is enormously valuable. Strategic income management, coordinating Roth conversions, RMDs, Social Security timing, and any large one-time transactions to stay below the IRMA thresholds is a sophisticated but highly valuable planning exercise. For a married couple near the lower IRMA threshold, staying just below it can save $2,000 to $4,000 per year in Medicare premiums. Over 10 years, that is $20,000 to $40,000 in savings from a relatively simple income management decision. If you are approaching Medicare eligibility or are already on Medicare, model your income carefully in the 2 years before any large financial transaction. Selling a home, executing a large Roth conversion, or taking a significant IRA withdrawal can all trigger IRMA surcharges that arrive 18 to 24 months later. Planning around those cliffs is genuinely worth the effort. The most fundamental long-term solution to the retirement tax bomb is what planners call tax diversification, having retirement assets spread across all 3 account types. Traditional tax-deferred accounts for money you want to defer. Roth tax-free accounts for money you want to compound without future tax consequences. And taxable brokerage accounts for flexibility and access without the restrictions of retirement account rules. With all three account types, you have the ability in any given year to pull income from whichever source creates the lowest tax bill. In a high-income year driven by large RMDs, you pull from Roth to avoid pushing further into a higher bracket. In a low-income year, you pull from traditional accounts and execute Roth conversions to fill the bracket cheaply. Tax diversification does not eliminate taxes, but it gives you the flexibility to manage them actively and intelligently throughout retirement. Let me give you a clear, practical action plan based on where you are right now. If you are between 60 and 72 and not yet taking RMDs, you are in the most valuable tax planning window of your entire retirement. This is the time to model your future RMD trajectory, execute systematic Roth conversions in your gap years, consider strategic Social Security timing, and evaluate whether your current account mix sets you up well for the distribution phase. A one-time consultation with a fee-only financial planner or CPA who specializes in retirement tax planning during this window is one of the highest return investments you can make. If you are 73 or older and RMDs have already begun, the tax bomb has started going off, but there is still meaningful action available. Qualified charitable distributions can eliminate RMDs from your taxable income if you are charitably inclined. Roth conversions above your RMD amount can still shift money to tax-free territory at today's rates. And careful IRMA management can reduce Medicare premium surcharges. You cannot undo the past, but you can absolutely reduce the ongoing damage. If you are in the early gap years, just retired, not yet on Social Security, RMDs still years away, you are sitting on the single most valuable tax planning opportunity most retirees ever get. Use it. Convert aggressively within your bracket. Fill every tax bracket dollar below your threshold with Roth conversions. Build the tax-free account balance that will protect your family from taxes for decades. The bottom line is this: the retirement tax bomb is real. It is built into the structure of most Americans' retirement savings. It arrives on a predictable schedule, and it is largely preventable if you plan for it before it goes off, not after. Here is the most important thing I want you to take away from today's video. Taxes in retirement are not just a line item. They are a system, a complex, interconnected system where RMDs, Social Security taxation, Medicare surcharges, and account types all interact with each other simultaneously. Managing that system well, with intention and advanced planning, can be worth more to your retirement than virtually any investment decision you will ever make. The retirees who feel financially secure in their 70s and 80s are often not the ones with the most money. They are the ones who built the right account structures, managed their tax exposure proactively, and arrived at their peak RMD years with a diversified tax base that gave them flexibility and control. You now know what most retirees never learn until it is too late. The gap years are your window. Roth conversions are your tool. QCDs are your charitable shortcut. IRMA cliffs are your guardrails. And tax diversification is your long-term foundation. Here is your homework this week. Pull up your most recent IRA or 401k statement and look at your balance. Then go to the IRS Uniform Lifetime Table and calculate what your RMD would be if you turned 73 today with that balance. Add your estimated Social Security income. Add any pension. Look at that total number and ask yourself, am I prepared to pay income tax on all of that every single year for the rest of my life? If the answer gives you pause, that is your signal to act. Drop a comment below and tell me, did you know about RMDs and Social Security taxation before watching this? Has your tax situation in retirement surprised you? Let's talk about it. If this video opened your eyes to something important, please share it with someone you know who is approaching or already in retirement. This is exactly the kind of information that changes financial outcomes, but only if people see it in time.